Hello everyone. Today we're going to do a quick question on cash flow statement using the indirect method. So first of all, we're going to have the equipment purchase calculation because that's what we're going to calculate. So let's get right into the question. An accountant is preparing the statement of cash flows using the indirect method. She found on the balance sheet that the prior year's balance of net of equipment was 295,700 and the current year's balance of net equipment is 304,000. Depreciation expense during the current year was 22,400. During the year, the company sold equipment for 40,000, resulting in a gain of 21,600. On the statement of cash flows, what is the cash outflows for the purchase of equipment this year? So again, the required is asking us what is the cash outflows for the purchase of equipment this year? What is the cash outflows for the purchase of equipment this year? I repeat. Okay, so this is a summary of what we got from the question, all the given information. If you want to organize that first of all. So the accountant is preparing the statement of cash flow using the indirect method. So we know that we're using the indirect method, which will start with net income. Prior year's net equipment balance was 295,700. The question literally gives us that. Current year's net equipment balance is 300 304,000. Depreciation expense is 22,400. Equipment sold for 40,000 with a gain of 21,600. So we know four details. First, last year, we know the prior net equipment balance was 295,700. Current year net equipment balance is 304,000. Depreciation expense is 22,400. Equipment sold is 40,000 with a gain of 21,600. So again, to recap, what is the cash outflow for the purchase of this equipment? Well, for the purchase of this equipment this year. So indirect theory and concept is that indirect method overview is that it focuses on adjustments to the net income. It focuses on the adjustments to the net income. So it will focus only to the adjustments to the net income. Adjusts for non-cash items such as depreciation, accounts for changes in working capital and equipment. So literally this question has a big equipment purchase piece, which we have a gain from of 21,400. Um, our equipment transactions involves purchases, sales, and depreciation. Book value differs from the price due to gains and losses. That makes sense. The equipment transaction usually involves purchase, which we have a purchase in this question, or it could involve a sales in a scenario, or it can involve a depreciation. Usually, the book value differs from the sale price due to its gain or loss. Now I've came up with a key formula to calculate purchases. So we know that purchases equal ending net income minus beginning net equipment. So sorry, purchases equal ending net equipment minus beginning net equipment plus book value of equipment sold plus depreciation expense. Why we're using this formula is to mainly adjust for changes in net equipment, which is the first key takeaway. Secondly, accounts for depreciation, for non-cash depreciation, adds back the book value of the sold equipment. So again, I will repeat the formula. We know that purchases equal ending net equipment minus beginning net equipment plus book value of equipment sold plus depreciation expense. So if you remember it this way, then it's good. But if you remember it another way, then feel free to rearrange the formula for your own benefit during any question given in the cash flow method. Data in the problem set now. We know that beginning net equipment is 295,700, ending net equipment is 304,000. Depreciation expense is 22,400. Equipment sold was for 40,000 with a gain of 21,600. Okay, so we have all the given values for the formula, which was ending net equipment minus beginning equipment plus book value of equipment sold plus depreciation expense gives us purchases. So we're solving for a book value of equipment. So we literally have to rearrange it to solve for the book value of equipment. So that would stay on this side, and purchases minus the change in equipment um, minus depreciation expense. That's how you get it. Okay, so sales price minus gain. It's going to be 40,000 minus 21,600 will give you book value of equipment at 18,400. So right now we're just calculating the book value of equipment. We know that we sold it for 40,000 with a gain of 21,600. So we're going to take out the gain to get the book value of the equipment. It gives us 18,400. The next step in the purchases formula is that we have the given values of beginning ending net equipment, which is 304 minus beginning net equipment net 295,700 plus book value that we just found out 18,400 plus the depreciation expense 22,400 will give us the cash flow outflow for the purchase of equipment this year is 49,100. Okay, perfect. So we found out what the question is asking us, and the key takeaway so far is depreciation is a non-cash, so it's added back. So just like over here, we added back depreciation for 22,400. Gains on sales and non-cash and excluded from purchase calculation. So gains and sales are non-cash excluded from the purchase calculation. So right here we took out the gain from the sale price. So that makes sense. Focus on actual cash moment when preparing the cash flow statement. Okay, that makes sense. So now I want to go deeper into this. If you have any problem that the question, we have already solved it. We got the final answer. The cash outflow for purchase of equipment this is 49,100. But I will took it a one step deeper on what are the possible outcomes of cash flows in all cash flow indirect method scenarios. So I'm going to sum that up for you guys. So please write this down and make notes, because this is going to help you remember to solve any cash flow indirectly using the indirect method on their operating side. So increase in cash flow can be a result from adjustments like depreciation, decrease in current assets, or increase in current liabilities, and a decrease in cash flow due to increase in current assets or decrease in current liability. Okay, the indirect method reconciles net income to a cash provided by operating activities. So I'm going to repeat the possible outcomes and go to the throughout the list of it. So increase in cash flow resulting from adjustments like depreciation, decrease in cash current assets, or increase in current liabilities. Decrease in cash flows due to increase in current assets or decrease in current liabilities. The indirect method reconciles. Net income to cash provided by operating activities. The indirect method reconciles net income to cash provided by operating activities. Okay, so I made down a list of all the changes that we could use to reconcile the adjusting cash flows. First category is non-cash adjustments. So if you have depreciation expense, we add that back. Amortization, we add that back. Gains on sales of asset, we subtract that. Losses on sales of asset, we add that back. Second is category is in the asset category. So changes in current assets, increase in accounts receivable. We're gonna take that, deduct that. Decrease in accounts receivable, we're gonna add that, so addition. Increase in inventory, we're going to take that out, deduct it. Decrease in inventory, we're going to add that. So third category is the liability side. Increase in accounts payable, we're going to add that. So just to reflect back on this increase in accounts payable, which is a liability, why are we adding that back in the operating side? So think about it. If a business has had more accounts payable which means they have to pay more of their bills. That's going to increase their liability. So that's why we add it back to the from net income, reconciling to the operating side of the cash flow using the indirect method. Okay, so that makes sense. So just kind of take a step back and think of an example that will help you recognize why it's being added or subtracted. So decrease in accounts payable, subtracted. Increase in accrued expenses, added. Decrease in accrued expenses, subtracted. Other adjustments could be deferred tax liabilities. If the question is really good, going deeper into indirect method, could be deferred tax liabilities or assets, changes in prepaid expenses, changes in unearned revenue. Okay, that just summarizes all the changes in accounts, adjusting cash flows, and hopefully I'll make a video on to do a more thorough cash flow questions. If you want to see that, let me know. I can dig up a question and do a more thorough where it goes through a lot more accounts adjustments than the one we just covered, which was just for equipment. And yeah, for you, take care. Bye for now.